Hello guys, good evening. Hello guys, good evening. Hello guys.
Hello, good evening.
Yeah, hello guys, good evening. Good evening. So let's get started, guys. Let's get started. All right, guys. So in today's Zoom session, remember today's Zoom session is about enlightening you guys on what you guys are doing wrong by following retail strategies, right? Hello guys, can you hear me? Hello guys, can you hear me? Can you hear me?
Yes.
Oh, yes.
All right, all right, all right. So remember, today's class is all about talking about the mistakes you guys have been making as retail traders and how you guys can trade, isn't it? So one of the mistakes you guys are making as retail traders, one of the mistakes you guys are making as retail traders is that you guys are not trading based on logic and facts. You guys are just trading based on guesswork and based on retail traders, strategies. So, and this is not what you guys are supposed to be doing if you want to make money in the market. You are supposed to be following how banks trade by buying where banks are buying and by selling where banks are selling. But in today's time, we found out that there are many strategies out there. We have smart money concept, ICT strategy, chart patterns and indicators, and so many other strategies out there. Now, if you guys look at it, 90% of these traders, they are not profitable. Why are you guys not profitable at the end of the day? Why are you not profitable? Even though we have uncountable YouTube videos on how to trade Forex, why are retail traders still not profitable? Well, the reason why retail traders are still not profitable is because you guys are trading against the big market participants. You understand? You guys are trading against them instead of you guys to be trading along with them. Well, it is not your fault. It is not the retail traders' fault because the retail traders doesn't know how to trade along with the big banks. Now, in today's session, I'm going to quickly show you how to briefly trade with the big banks and how big banks usually trade in a very quick preview, okay? So let's say, for example, big banks. Now, what you need to realize is that I'm a mentor who happens to be trading for about 11 years now. 11 years. I've been trading since 2011, okay? So, but when I started Forex trading, I didn't know anything about Forex trading because I was a network marketer before. Previously, I was a network marketer for GNLD company, and I was also a network marketer for Swiss Golden, okay? So, but one day I came across Forex trading and then I decided to venture into it. But when I started, the strategy I was taught by my mentor then, by my first mentor then, was technical analysis and chart patterns. Then one day, I saw an article one day by Goldman Sachs. The article actually states that Goldman Sachs hardly lose a single trade in a given year. So this surprised me because if Goldman Sachs hardly lose one single trade in a year, it means that there's something they are doing that we retail traders are not doing in our strategy. And because I know that it is human being trading for this Goldman Sachs. So if human beings are the ones trading for this Goldman Sachs, it means that there's something they are doing that we as retail traders are not doing. Then I went deeper into my research. As I went deeper into my research, then I came across my mentor, who happens to be Sam Seiden. So Sam Seiden is one of an ex-bank trader, it's an American bank trader who happens to be trading for JP Morgan for over 25 years. However, he's retired right now, okay? So he was the one that mentored me on how to trade institutional order flow trading, all right? So my trading perspective is from the big bank side of trading. Now, how do banks trade? Or what usually move the market price? What usually move the market price, if you might ask yourself as a retail trader? As a retail trader, you guys don't know what usually move the market price. You guys just know how to plot trend lines. You guys just know how to plot trend lines and so on and so forth, which is very, very wrong. That is not how to trade. Now, what usually the primary principle of what drives the market price, whether it's driving it up or whether it's driving it down, is volume, okay? What usually drives the market price is volume. Now, retail traders don't know where there's volume in the market and where to know where there's no volume in the market due to their strategy. And this is why the retail traders are losing money in the forex market every single day, because remember, as retail traders, even if you are a demand and supply trader, we all know that as a demand and supply trader, you should be able to know that this is a buy formation, this is a sell formation, right? We all know this. Every retail trader knows about market structure, right? But one thing retail traders don't know is location. What is location? Location is, for example, if you have a beautiful house in the village, and you have an ugly house in the city, which house do you think is going to be worth more in value? Do you think the beautiful house in the village is going to have value in terms of money value? Or do you think the house in the city, the ugly house in the city, is going to have value? Yes, the house in the ugly house in the city is going to have more value than the beautiful house in the village, isn't it? Why? Why is this? This is because of the location of where these two houses are, right? So location matters a lot in forex trading. You might understand market structure and so on and so forth. You might understand market structure and so on and so forth. But what you don't understand is location. Because I believe you guys all know that we have many demand and supply zones. We have many demand and supply zones in the market, right? Hello, guys. Are you guys there?
Yes.
So we have many demand and supply zones in the market. Which of the demand and supply zone? We have the retail traders demand and supply zone. We also have demand and supply zone of the big banks and other institutions. Now, as a retail trader, how can you take advantage of knowing how to ignore the demand and supply of retail traders and how to take advantage of the demand and supply of big banks and institutions? How are you going to know this? Now, to be able to know this, you need to be using a professional tool. You understand? Now, this professional tool from Clusterdelta platform, because we have many professional tools out there. We have a professional tool that we call Sierra Charts. Previously, I usually used Sierra Charts in my analysis. Okay, we have Sierra Charts, we have Clusterdelta. Now, all these platforms, they replicate the exact tools big banks usually use on their trading floor. Remember, I was mentored directly by a mentor trading for big banks, right? So my mentor happens to tell me the tools they are using in the big banks. You understand? So it is very, very similar to what you guys are seeing currently on my screen right now. I believe you guys can see that this is the market profile on my screen.
Yes, sir.
So I believe, hello guys, I believe you guys can see that this is a market profile on my screen, right? This is a market profile.
Yes,
Now,
sir.
this market profile, you can see that on this market profile, it shows areas where there's high volume node, and it shows area where there's low volume. Can you see this area is having low volume, as you can see, right? And this area is having high volume. Can you see that? You can see this area is having high volume node, and this area is having low volume node. There's low volume around here. There's low volume around here, but there's high volume around here. Now, as a retail trader, I believe you guys know that you don't know the exact area where there's volume in the market and where there's no volume in the market. You guys are just trading any formation you see in the market. Okay. Now, this is not how to trade. Okay, this is not how to trade. You guys need to start understanding how to start taking advantage of professional tools. Professional tools. Now, there's a way how this is how banks usually trade. Let me quickly show you how banks usually trade. This is their mentality. Let's say banks have, for example, gold. Let's say banks want to buy gold worth $100 billion, for example. If banks want to buy gold worth $100 billion, they won't buy all the gold with this whole $100 billion. They won't buy it with all the money at once. Do you know what banks usually do? Banks like splitting the money into pieces, which we professional traders, we call it ice badge. We call it ice badge orders. Ice badge orders. Now, what is an ice badge order? What is an ice badge order? Let's quickly go to Google and search what an ice badge order is. Okay, let's quickly see what an ice badge order is. So I believe you guys can see my screen, right? So you can see what Google says. It says that an ice badge order is an order that is usually sliced into what? Into smaller orders. Can you see? It is a big order. It is a large order that big banks usually split into pieces. Do you understand? Ice badge orders are orders that big banks, it is big orders that big banks usually slice into pieces. Why are big banks usually slicing their big orders? There are billions of orders. Why do they usually slice it into pieces? The reason is because they are trying to hide the details of their transaction from retail traders so that other retail traders cannot see the details of their transaction. Because remember, forex trading is a zero-sum game, right? Because another trader's loss is another trader's profit. You understand? Now you can see here, ice badge orders mainly used by who? You can see it is mainly used by big institutional investors to buy or sell large amounts of quantities of securities and so on and so forth, right? My point here, and the point I'm trying to make here is an ice badge order is an order that big banks usually make, and they usually break it into smaller pieces, because they are trying to hide the details of their transaction. If, let's say, for example, you are playing a card game with your opponent, I believe you know that you are going to cover the details of your card for your opponent not to see it, because if your opponent is able to see the details of your card, he's going to take advantage of that information, right? So that is why big banks usually hide the details of their transaction for retail traders not to see. Now, as a retail trader, how are you going to take advantage to be able to see the details of the transaction big banks are making in the market? It is by using professional tools like the market profile. You can see this is market profile and volume profile joined together as one. This is the value area high of the profile. This is the value area low of the profile. And you can see this red line here. I believe you can see this red line, right? So this red line is the point of control. This red line you are seeing here is point of control. You can see this red line here is point of control. Now we also have what we call the imbalance tool. Now this imbalance tool on Clusterdelta, for example, it is going to help you a lot in knowing where imbalances are in the market. It is going to help you a lot in knowing where imbalances are in the market. Remember, this was the trade I took today on this Euro USD, right? Now, you guys can see too many green dots and red dots. You guys might be asking, is this an indicator? No, this is not an indicator, right? This is a professional tool. This is a professional tool, and this is a futures market. This is a futures market. So this futures market made by Clusterdelta, whenever you plot it into your MT5 or MT4, it is going to make your MT4 into a professional trading platform. Now, you guys can see too many red dots and green dots. Now, are you going to be taking trades on all these dotted areas? No, you won't be doing that. What you are going to be doing is to look for areas where there is a high formation, that a very good formation, buy formation, or a sell trade formation. If you are a demand and supply trader, I believe you guys know what a buy trade formation looks like, and you guys know what a sell trade formation looks like, right? So now let's say, for example, today during the Frankfurt session, you can see how banks have large quantities of buy imbalance. You can see the buy imbalances that we are having here, multiple buy imbalances here. Now, the reason why big banks are having these multiple imbalances is because they don't want to put all these imbalances in one place. Because if they put the imbalances in one order, retail traders are going to see the details of their transaction. So that's why they splitted these imbalances into pieces. You understand? Now, if you notice, let me put my mouse on this imbalance, on the green area. You can see how many imbalance we have here. You can see we have 23 times 0 imbalance. What is the meaning of 23 times 0 imbalance? The meaning of 23 times 0 imbalance is that we have 23 contracts traded on this level, and buy contract traded on this level, and we have 0 sell contracts traded on this level. So we have multiple imbalances. You can see this is the first imbalance is 23 times 0 buy imbalance, 12 times 0 buy imbalance. We have 23 times 0 buy imbalance. We have 16 0 buy imbalance. We have 10 0 buy imbalance. We have 34 0 buy imbalance. Now, when you plus all these imbalances together, at least it is over 100 imbalance that we are having on this area. This is over 100 imbalance. Now, even if you can see only one imbalance in the area, so far as that imbalance, so far as the transaction, the contract on the imbalance is about 1 million and above, 1 million and above, then it means that banks are the ones having that zone. It is the zone of the big banks, you understand? Because retail traders don't usually have the capacity to be able to trade millions of contracts at a go in the market, you understand? Because remember, if banks are moving the market down in a massive way like this, it is going to take retail traders a lot of effort to move the market down in a way like this, right? It is going to be weak. Their movement is going to be weak coming down. But remember, big banks have the capacity to move the market aggressively going down. So my point here is, using the professional tool, you should be able to see areas where we have imbalances in the market very, very easily, very, very easily. Now, you won't be trading all these sell imbalance or buy imbalance blindly, remember. You should only be trading buy imbalance in an uptrend situation, and in an area where we have a very good market structure and a zone, you understand, as a demand and supply trader, you should be able to know a very good demand zone. So on that your demand zone, whatever strategy you are using, try to see if there's imbalance on that area. If there's imbalance in that area, let's say, for example, you can see this formation here of a draw-based rally that we're having here. You can see that we are having an imbalance in this area, right? Now, the imbalance that we are having here, let me see how many imbalance it is. You can see this is 10-0 imbalance, 10-0 imbalance. On Euro USD, one Euro USD contract is 125,000. One Euro USD contract is 125,000. So 125,000 times 10 times 10, you can see this is 1.2 something million. Can you see? So that is about a million contracts on that area. So if price happens to come back to the area, if market price happens to come back to this zone, we are expecting market price to rally up. We are expecting market price to rally up because the owners of this formation, the owner of the zone here are big banks. You understand? Are big banks. Now, what about all these sell imbalances that we are having here? Are we going to be ignoring all these sell imbalances here? Yes, we are going to be ignoring it because it doesn't make sense if we are selling, if we are selling in an uptrend. You understand? So even if we see a sell imbalance in an uptrend, we are going to be ignoring all those sell imbalances in an uptrend and only focus on the buy imbalances we can see in an uptrend. You understand? So let me show you an example. You can see this area. This area here is giving us an imbalance of, this is 24-0 imbalance. 24 imbalance, this is 24 imbalance also. You can see this area alone is showing us an imbalance like this. You can see the reason why markets came back to the zone here. When markets came back to the zone here, you see how markets push up. Now, many retail traders won't be able to know the reason why market was going up, not knowing that 24 plus 24, you can see we have two 24 imbalances here. 24 plus 24. That's 48 imbalance, right? 48 imbalance. Now, 48 imbalance times what? 125,000 contracts. Remember, one euro is 125,000, right? So using mathematics, a very simple mathematics and using trading logic, 48 imbalance times 125,000 is going to give us what? Let's use our calculator, please. Let me use my own calculator here. So 48 times 125,000, it is going
6 million.
It is going to give us 6 million. So do you think retail traders are the ones trading 6 million on this zone? Do you think retail traders are the ones trading 6 million on this area? It is not possible. You understand? It is not possible for retail traders to be trading such high contracts. Do you understand my point? So if you are a scalper, this Clusterdelta is going to be very good for you because you only need to be scalping the Frankfurt session and the London session and the New York session. Now you can see we are not in an uptrend. In an uptrend, we are ignoring all these sell imbalances here because it doesn't make sense to be selling in an uptrend. We also have what we call the market profile. We also have what we call the footprint. Now this is what many retail traders are missing in their trading. So I believe you can see this is the footprint chart. Now on this footprint chart, I believe even if you are a retail trader or you are any demand and supply trader, you can see that there's a zone around here, right? There's a zone here. There's a zone around here. Now in this zone, you can see how price came back to the zone here. market price came back to the zone here, right? You can see how market price came back to the zone on the footprint charts. Now, when markets came back to the zone, what can you see on the footprint? We can clearly see that there's a shift in price. You can see there's an imbalance here, 129 buy imbalance. It means that we have high buyers in this area, right? Now, market came back to the zone. When market came back to the zone, let me highlight the area. When market came back to the zone, what can you see? You can see that we have massive sellers coming into that demand zone. This is the type of formation I'm talking about. The formation you guys are seeing here right now, this is the formation if it's on the candlestick chart. This is the formation. Market price came back to the zone like this, and then we saw a rally going up. This is the rally in price. This is when market came back to the zone, and this is the formation around here. It is not possible for me to show all this area at once on the screen. You understand? That's why I'm not able to show it in a full screen like that. So, but my point here is when market price came back to the zone here, you can see we have massive sellers coming into the demand zone. But you can see we are expecting, look at it, we have 137 seller, 144 seller, 196 seller, 127 seller, 160 seller, 140 seller here. All these sellers here, what are they supposed to do? They are supposed to move the market down aggressively, isn't it? That is the expectation. But look at what they are doing. They are staying stagnant in the area. Why are these sellers staying stagnant in the area? It is because they are being exhausted. They are being trapped in the area. These sellers are being trapped in the demand zone. So it means that whenever all these sellers are coming into that demand zone, the bigger players are swallowing them. The bigger players are swallowing the others, these sell orders. You understand? The bigger players are exhausting the sell orders that is coming into that demand zone. Immediately when the exhaustion is completed, you can see we have a finished auction around here. You can see the finished auction. 16.0 is a finished auction. It means that the transaction in the area is finished. You understand? It's finished. It means there is going to be a shift in price to be going up. You can see from a negative delta here, from a negative delta around when price came back to the demand zone, you can see we have 90 what? We have 95 negative negative delta here. And you can see the volume, right? You can see we have 997 volume around here, negative delta. But this volume and the negative delta was not able to move the market down aggressively. Now, what happened next? What happened next is on the next candlestick that opened, remember this is the 5 minutes time frame, okay? This is the 5 minutes time frame on these footprints, okay? So on the next candlestick that open, what can you see? You can see a shift in the delta from a sell delta to a positive delta, from a negative delta to a what? To a positive delta. It means that there's a shift in buyers from a seller to a buyer when price came back to your demand zone. Is this an information you guys are seeing whenever you are trading? No, this is not an information you guys are seeing. What you guys are trading is you are trading based on guesswork. You are just trading based on guesswork. You are not trading based on facts. But you can see here, with the help of this cluster delta, you should be able to be trading with facts in the market. The fact here is that we have sellers. These sellers here were exhausted, were trapped. And then you can see how we shift from a seller to a what? To a buyer.
Hello.
You can also see the increase in volume, right? Can you see the volume increase on the area? And then from that point, you can see how market price rallied up from that point. Look at it. Can you see how market price was moving up?
Excuse me.
Yes.
Can you please repeat for that area?
Which area is that?
All of that, those figures of delta, how it changes.
All right, so you can see here, you can see just above the candlestick that we are having here, just above it, we are having a negative sell delta, right? You can see we are having a negative delta here, 95 negative, right? Then when you can see, it means that all these sellers here are being absorbed, are being trapped. All these sellers that you guys are seeing here. Can you see all these sellers, guys? You can see.
Yes, okay.
Now, all those sellers are being trapped in the area. And then from the next candlestick on the 5 minutes time frame, when the next candlestick open, remember, on this candlestick, we didn't enter the trade. When price came back to our demand zone, we didn't enter the trade on this candlestick. We waited for the candlestick to close. When the candlestick closed, then we saw a confirmation on this candle. After seeing the confirmation on this candle, then we enter our trade on the next candle here. You understand? So the confirmation candle here showed us that there's a shift from a seller to a what? To a buyer. You can see the shift from a negative to a positive. And also you can see the increase in volume, right? From 197 volume to 1058 volume and so on. And that was what was able to move the market aggressively going up. Now let me, right now I'm using the bid and ask setting. Now let me change it to delta setting. Let's see what is happening on that zone. You can see on the same zone, on this same zone, using the delta, you can see all these sellers here were not able to move the market down, because look at it. Does it make sense to be having 101 sellers and the seller should not be able to move the market down? It doesn't make sense, right? It doesn't make sense. It doesn't make sense. So we also have what we call the VWAP. We also have what we call the VWAP. So on the VWAP, what is the meaning of VWAP in the first place? VWAP means volume weighted average price. You understand? VWAP is going to show you areas where there's volume in the market and area where there's no volume in the market. So with this VWAP, you should be able to know how to enter your buy trade and sell trades and so on and so forth. For example, if I want to trade what is going to happen here tomorrow, this is going to be my analysis. This is going to be my analysis. I'm going to extend these VWAPs into the next day. I'm going to extend this VWAP into the next day. If I extend this VWAP into the next day, remember, I'm going to check on the market profile also to see if there's volume around this area. I'm going to check on the market profile to see if there's volume around the area. Let me check on the market profile. So on the market profile, the area we're having here is this. Hold on, guys. This loading, right? All right. So you guys can see that we have a lot of volume around this zone, right? It means that if market happens to come back here, we have a point of interest around here for selling. Do you understand? We have a point of interest around here to be selling. Because around here, you can see we have low volume here, no volume, right? Around here, we have high volume. Is this an information retail traders don't need? Of course, you need this type of information to know where you need to be trading and so on and so forth. You understand? Because some people, if they don't have this tool, for example, you might be waiting for the zone above here. You might be waiting for the zone above here, not knowing that you can quickly take a quick trade on the zone below here. And if this trade on below here happens to work out, let's say, for example, market price came to the zone and market price went down, you can see that the profit has been given, right? The profit has been given on this trade. Now, after the market can decide to go to the upper zone and also work out. So this is how markets usually play out. You understand? This is markets usually go from equilibrium area to an equilibrium area, equilibrium area to an equilibrium area. Now, one thing about auction market theory says that this is the value area low. This is the value area low. This is the value area high. I believe you can see the color, right? You can see the color. So this area here, this gray area is where 70% of trading usually happen in the market. You understand? So it means this is inside value. This area here is inside value. This is inside value. Don't mind my writing, please. So from this blue area down, from this blue area like this downwards, it is outside. It is outside value. You understand? This is outside the value. So if market happens to go outside the value, market happens to go outside the value, this is what auction market theory says. Let me show you what auction market theory. Auction market theory says that if market happens to go out of the value area low, then we should expect price to come back into the value area low again, and then go, market should be able to go down. You understand? Maybe you guys can screenshot this and see how this area is going to happen tomorrow. You understand? Just see how this area is going to play out tomorrow. Okay, you can screenshot this and say I told you this on Zoom, because I know it is going to happen. I know it is going to happen. There's high volume in the area. We also have the point of control in the area. You can see the point of control, right? Point of control in the area. That red line is the point of control. All these things are what we usually look at to make trading very, very easy. To be able to make money in the forex market, you don't need to make it hard on yourself. You understand? You don't need to make it hard on yourself. I see many people trading 40, 30 years.
Excuse sir.
Yeah.
Sir, please, where did you explain that is the point of control?
This area is the point of control. This area here. You can see there's
The
a
red area.
Yeah, the red area is the point of control.
Okay, thank you, sir.
Can you see that? So you can see on that point of control, tomorrow you can see this period separator, right? Can you see this period separator? This vertical line here is what we call period separator, okay? It is what separates the day. So this is yesterday. Today is what? Today is Thursday, right? This is Thursday here. And this is going to be Friday here. You understand? So there's a way big banks usually trade. Let me quickly tell you how banks usually trade. Banks usually trade by having an uncompleted transaction towards the ending of the session, or towards the ending of the week, or towards the ending of the week, or towards the ending of the month, or towards the ending of the day of the year, or towards the ending of the day. You understand? So you can see here on Euro USD, banks are having an uncompleted transaction here towards the ending of the what? Of the trading day. Which means they are going to come back on the next day to come and fill it up. They must come back to fill it up. They must do what? They must. It is a must. It is a must. Do you know why it is a must? Now let's go back to the first logic I'm trying to show you guys. The first logic is that, remember, banks want to buy gold. Banks want to buy gold worth 100 billion. Before we diverted into that, what 100 billion? And remember, I told you about iceberg orders, that banks don't usually put all their money in the market at once. They usually split their money into pieces. So let us assume that banks happen to split their money into pieces. The 50%. Hello guys, please, if there's noise in your background, mute your mic. Just mute yourself, okay? All right, guys. Hello. All right. So you can see if let's say, for example, roughly, let's say banks splitted their transactions into 50-50 around here. Let's say they splitted their transaction into 50-50. Now let's assume this is the zone of the big banks. Let's assume this is the zone of the big banks here, for example. Now let me quickly use a logic. Let us assume this is your house. Let's assume this is your house here. That's the fencing of your house, and so on and so forth. This is where your rooms. This is where your rooms are. Your rooms. You have your wife, your children, and so on and so forth here. This is your compound where you park your cars, and so on and so forth. You understand? This is your place of work. This is your place of work. This is the gate of your house here. And this is you here. This is you here. Every day, you usually go out to work, to your working place. And of course, you also have some houses at the back of your house. You also have